It's April 2025, and this month the question I've been getting more than any other is how do I take advantage of the chaos in the stock market? How do I buy the dip? What am I supposed to be buying? What are you buying? Well, today in this episode of my Larch Fund series, I'm going to talk about exactly what I've been doing this month of April. It has been an incredibly chaotic month. It's one of the reasons why I left this video so late in the month, because so much happened throughout the time. I've bought a couple companies, I've added some new ones to the portfolio, and of course, I have been going through my strategy of how I want to build my portfolio for the long term, and specifically how Canadian oil and gas companies have fit into that narrative as I've talked about them for the last month or two. Welcome to Golden Larch Investing. My name is Liam. In today's episode of the Larch Fund, I did just want to shout out you guys. This channel just crossed 1,000 subscribers, and things have happened that I never expected to happen. I've had so many positive comments. I've had so many people following along, so many people interested in investing that want to talk about it with me. It's been massive for me, and I thank you all so much for your support. Today, I'm going to go through my portfolio. I'm going to talk about my strategy. And I'm going to give a couple pieces of just sort of generalized advice for a Canadian retail investor who's looking to buy the dip right now in this chaotic trade war era of early 2025. So let's start off on Snowball Analytics here by looking at my portfolio. And I'll have this up on the screen for you guys. But as of right now, the value of the portfolio is $24,216, which of course, as you can see right there, is about $1,000 less than the total amount invested. Obviously, short term, that sucks. Long term, that means a lot of these companies have fallen below my cost basis. One of the big ones here, you see on the funds side, I've got about $10,000 invested. And that, of course, is thanks to my largest position, the S&P 500. Now, I talked about this. I talked about doubling down on the S&P 500, something that I plan on doing again in the not so distant future, to be honest with you. I've made a couple of purchases in here, but obviously stock market's been down pretty bad. I bought in at sort of the late 2024 peak, and I told everybody I'm going to dollar cost average. That's absolutely true. My next tranche should go in the next little while. Obviously, it's tough when you're buying such a large quantity, right? Especially the ETF I've picked, SPY, is one that I've picked more out of familiarity than anything else. It's not necessarily the best one. I would probably, if I was restarting this portfolio, be picking something like VFV or VOO, but SPY was what I used when I was sort of trading as a younger investor. And so to get a large number of shares of something that's that expensive obviously costs a lot. And I haven't been doing a lot of fractional shares. I've been doing pretty round number buys. Then we get into the next group, which you'll see is the only positive one, and the one I've obviously spent the most effort talking about on the channel, energy. Now here we've got 4 names. First one, and the largest position here, is Enbridge, ENB. I've talked about these guys. I'm up almost 24% on my position, which is great. It's 36% of my energy portfolio here. I have 50 shares. I also hold 50 shares of Canadian Natural Resources, which is here. It's the light blue. Canadian Natural Resources is closer to 25%. I hold 50 shares there as well. Those are down. I do plan on buying more. Over here, we got Pembina Pipeline. Again, one of these like really classic dividend payers. Smaller position. I am down just a tiny bit. 2%, not a big deal. And then the newest member of the group, Tourmaline Oil. Bought these guys about a month ago. 25 shares. Not a huge position, right? About $1,000. Down just about 1%. So essentially hasn't moved at all since I invested into that position. Then we get down to financials. There's another new name on here. Royal Bank of Canada, one of the first stocks I ever talked about on here. One of the companies I've had the longest sort of relationship with. I had a parent that worked for them when I was a little kid. I had, my bank account there when I was young. I've had a bank account there since. So long relationship with that company. Strong believer, biggest company in the country. Really think they're one of the best companies you can buy as like a long-term buy and hold forever stock. Then we got National Bank of Canada, who I believe are, I should say, the most undervalued of the big 6 banks in Canada. They're one of the fastest growing. I really love their Western Canadian push. I am biased as a Western Canadian myself, but I think they've sort of tapped into a lot of really good opportunities. And of course, It's down about 7% since I bought in. So there is opportunity there for me to drop my cost basis. Speaking of which, then we have Equitable Group. Equitable Group sits outside the big 6 banks in Canada, but they are a really interesting opportunity. They're the disruptor bank. I think they're one of the opportunities that would gain the most in a situation where things ended up going sort of wrong for the Canadian banking sector. And if the Americans sort of get their way here, that might happen. Then we have Brookfield, of course. I've talked about them on the channel before. We've done videos on them. They're in the news a lot for reasons that are kind of outside of their control. But really great asset manager. I've bought just a little bit. Obviously, I overpaid for my position if I'm down 8% already, but I plan on buying more. I think they're a great asset manager. They've got great compound annual growth rates. I think the total return CAGR over the last 5-10 years was something like 25%. If you can get that, if you can get 25% a year long term, fantastic. And with such a diversified business model, it's one of those models that you really want to be buying at a time like this because they offer just intrinsic diversification. Buying into this company means you own, a slice of all these different pies. That way you're not really putting all of your eggs in one basket, the way that sort of my energy position is. Then we get down, last name on the list here, Canadian National Railway, one of my favorite companies. It's one of the ones I think is the best example of a buy and hold forever company. Obviously, it's 100% of my industrials group, but I think it's fantastic. Again, it's down about 5%, so there's opportunity to drop my cost basis. I'm not rushing into this one right this second because I think that things are maybe going to get worse before they get better, but really, really great company. And obviously, it's a fantastic opportunity at any time to buy if you're willing to hold it forever. So with my portfolio fully out there for everybody to see, the question really is, how am I buying the dip? What am I doing? What is the right way to take advantage of this opportunity? And there's 2 things that I've been doing right now. And the first, and I think this is really important, I haven't been panic buying. You'll notice I have put a little bit of money into my portfolio, but I have not been draining my emergency fund or, taking out margin loans to go out there and buy, distressed S&P 500 names, right? I'm not out there trying to snipe Nvidia at the bottom. I'm not out there trying to, to catch the opportunity on any of these stocks that have lost their luster. I'm not going to try to time a reversal on something like Tesla, right? That's been down so much. That's not what I'm doing. I'm not out here making unsustainable moves. I'm also not changing my investment strategy. I have been talking ad nauseum, literally constantly, about Canadian oil and gas over the last 2 months because it's a really fantastic opportunity. But that doesn't mean that I'm not going to continue owning fantastic Canadian dividend paying stocks. That is my fundamental stock market portfolio building strategy. That is what I have planned to do. That is what I'm going to continue doing. So while, yes, there are great opportunities in Canadian oil and gas that present huge asymmetric return, I'm not throwing every single penny into that area. I'm not selling out of other high quality companies to buy into that sector. Because by keeping my portfolio the way it does, even if I've allowed energy to become a pretty big chunk, I haven't put myself in a position where I'm at any real risk of one sector collapsing my whole portfolio. And that's another really good point right now. A lot of people are going out there thinking, hey, tech is down so much. Big tech, Mag 7, all these big names are down so much. Maybe I should just funnel my money into there. And that might work. And the Mag 7 is a pretty big group that has obviously their sort of business interests in all sorts of different sectors. But if you're going to put all your money into one sector, you run the risk of that sector underperforming. I also think there's a good opportunity here to talk a little bit about geographic risk. Almost this entire portfolio is concentrated in Canada. Every single individual stock I own in this portfolio is Canadian. They run their business in Canada. They have at least a main chunk of their portfolio in Canada. They operate out of Canada. And yet you'll see that the largest fund I own is not a Canadian fund. Because if my large ETF purchase was also just Canadian, if I was going to pick a Canadian option, well, now all of a sudden I've tied every single bit of my portfolio's returns to the Canadian economy. And while I'm bullish on Canada and I believe in Canada over the long run, I don't want to put all my eggs in one basket. And I don't think you should as well. A lot of American investors are pretty used to being able to just invest in American companies and outperform. At least since the financial crisis, that's been the case. The US has outperformed the rest of the world dramatically, but that is not always the case. You can cherry pick time periods where other countries have outperformed the US. You can cherry pick time periods where other countries have been the clear winner, where you should have had your money in places like China, in places like Europe, in emerging markets, in Canada. But as a long-term investor, I don't want to depend on cherry pick data. I don't want to depend on one country's economy outperforming. I want to put myself in a position to succeed regardless. And so I'm going to diversify my portfolio beyond borders. I'm going to diversify my portfolio beyond sectors. And that's a really key, important thing to think about right now. If I was a brand new investor, right now, I would probably be looking for some sort of all-in-one ETF. I'm sure there are fantastic options out there. I have not done in-depth research into every single one, so I'm not going to, name a ticker here and then have it underperform for the long run. But if I was looking at my opportunity, if I had the same amount of money, right? If I had $25,000 and I was just going to pick something to buy at this time when everything is dipping, I would probably be dollar cost averaging into like an all equity ETF, because I think that's probably the safest move. So if you're somebody who's looking to put money into the markets and you're thinking, oh man, I want to just be safe, that's probably a good idea. At least until you have time to really understand the companies you want to invest in, to understand the strategies you like, and to decide whether or not you want to allocate a specific amount of portfolio to a certain country, to a certain sector, or like me, if you want to pick a specific part of a specific country and then invest in that sector. So for me, Canadian dividend payers, that's what I've done. And then obviously I have a big focus on energy, that's up there. I have a big focus on financials, and that's up there. That's just what I've been doing. Every investor is going to have a slightly different play. If that's sort of what you're doing, it looks like you can follow my lead more or less. But if you're doing something totally different, you're a big growth investor, you want to invest in tech, you want to invest in long-term compounders, whatever your strategy might be, it might not look exactly like this, but it probably should start by at least having some sort of diversification outside of your core portfolio, right? Some sort of, large central area that all of these other investments can orbit about. And that's what I've been doing. That's how I'm buying the dip. That's the best way, in my opinion, for an investor to buy into the markets right now. And the final thing I'm going to mention is all about dollar cost averaging. I have seen so many people commenting about how they are down really quite badly on some of these positions, right? So I talked about Synovus recently. Obviously, that stock is down brutally. If you bought at the peak, you could be down 40+% on your money, and that sucks. But if you are a buyer of stocks, if you are currently actively investing, as in you have money, you are working your job, you don't rely on that money to live, and you can afford to put it into investments, then you're at a great opportunity to drop your cost basis, to increase your position, to increase the dividend, and to make a way larger return long run. There are so many examples of companies that have dipped only to rebound and hold the rebound. There are so many opportunities where the market itself dips and you can buy in. And so dollar cost averaging is always my recommended strategy. Pick a set amount of money, a set interval, and just buy, because then it'll do that process for you. Better yet, pick an ETF. Pick, whatever, the VOO, right? The S&P 500, put in the amount of money you can afford to put every single month, automate the process, and do it so that you don't have to worry about it at all. Dollar cost averaging is a great way to make sure you're not in a position where things drop and you no longer have any money left to invest. And the final thing I'm going to say right now, if we are looking at a recession and you are a stock market investor and you are not certain you can afford to hold your position, you need to be thoughtful about how are you going to exit if you need to, what options are available to you, and should you be buying right now? If, for example, you work in an industry that's going to be impacted by the trade, by the tariffs, by the recession that might be coming or whatnot, think about what you can do to protect yourself financially so you don't have to take that loss. Because if you're that investor that bought Cenovus at the peak, you're 40% down, and you've now lost your income and you don't have an emergency fund, you're going to be cursing the day you bought that stock. So try and make sure you're not in a position where you've invested more than you can afford to. Try and make sure you're shoring up your emergency fund before you're allocating more money to the stock market if you're in that kind of position. If you're not, congratulations. You have a fantastic opportunity, and I wish you the best of luck. And with that being said, that's about all I have for you folks today. I think this was a pretty good breakdown of my personal portfolio, of my thoughts about the current market environment. And I do want to end again by just thanking so many of you for subscribing to the channel, for liking the videos, for commenting, for sharing your thoughts, and for just engaging in this community we've built here. It's super valuable to me. I really, really appreciate it. I think it's really interesting. Never expected to make it this far. So again, thanks so much for that. And I will see you in the next video.